Top Picks is brought to you by Questrade, where you can trade stocks from 1 cent and buy ETFs for free.
David's first top pick, Alphabet, the people who run Google.
That's right. So we like to invest in companies that are firmly in the middle of some structural change taking place in the underlying economy. And we know that the internet continues to boom, and we know that Google is responsible for 64% of all the searches that are done on the internet. So as traffic on the internet grows, they continue to benefit. Now, they are in the middle of the shift in spending for media and spending for advertising that's coming from traditional media to the internet. And they're, of course, they're getting the lion's share of that growth in advertising. In the most recent quarter, their revenues for a company as big as it is grew 26%.
Wow.
When you take out the impact of currency, versus 23% in the most recent quarter. So as big as it is, its revenue is accelerating, right? Growing faster. At the same time, their margins are improving because they're managing their costs really effectively. So Ruth Port, who came in as CFO, is doing a great job of managing the resources. So that's the first thing. The second thing, of course, the reason that internet traffic is booming so quickly is video. They own YouTube, and of course, they're firmly in the middle of that. The last thing, we like defense companies, and we've talked about them over the last year because you never really know what else is in there that can come out and generate revenue later. And Google is probably the greatest brain trust in any company in the US. All kinds of things in the skunk works that will turn into products as time goes along. So stocks pulled back 10%, firmly in an uptrend, so technically very sound in a space that will continue to grow. It's good getting better. It fits exactly what we look for.
And you just remind us, there's two types of Google stock. There's the straightforward Goog, G-O-O-G.
We own the Google C.
Right. Is that the one with the symbol L, with L on the end?
No, G-O-O-G.
Okay, and what is that? What stock is that?
That's the Google C. It's got the internet search. It's got YouTube.
Okay. Right, that's the one you're going with. General Electric, an old standby, but of course, this stock for many years underperformed.
Right, so again, I want to go back to process. When you go through a correction like industrials have over the last year, you want to find the one that behaves differently than the rest, okay? So GE has a tremendous portfolio of products. They've been going through a transformation where they've been selling off their financial and banking assets, which made them a systemically important bank. So they're going to wind up with additional free capital that they can buy back shares and increase dividends with. They're going to wind up with a higher return on their invested capital in the business. And again, technically, stock behaved extremely well through the correction. So you're going to get a great yield. There's going to be share buybacks. You've got a portfolio of products that are growing around the world in a sector that is now recovering. So you're able to buy the best business in a sector that's been correcting for the last year and now showing new strength.
And so General Electric, obviously a play on renewable energy as well, if that works out. They're trying to get big and green. They're already big in oil and gas equipment. Yeah.
Well, they are, and that's the one piece that we have to watch, right? They get 7-8% of their revenues out of the energy space.
Wow.
But the wins that they have in other parts of the business are substantial.
And then finally, SherwinWilliams. Now, you seem to like these high-priced stocks. Google at north of 700, SherwinWilliams north of $250. I say high price, nominal high price.
From nominal high price. Yeah. Look, we just look at trying to find parts of the economy and market that are benefiting from a structural shift. The U.S. consumer is slowly improving, right? Low energy prices, great for a consumer. Home improvement is an important part of the U.S. market. We talked about Home Depot for a couple of years now. SherwinWilliams is sort of the best brand in the paint industry. And so as the economy improves and as people spend money on their homes, SherwinWilliams benefits. As new homes are built, SherwinWilliams benefits. But the other piece of it is their biggest input cost is oil or petroleum products, and we know what's happening with the price of oil. So you've got costs that are under control, you've got growth in demand, and you've got 80% of the revenue coming from the U.S. So it's not dependent on China or emerging markets or even Europe. You're investing in a business that sells its product into the strongest economy in the world.
not a huge yield. From what I'm seeing, a yield of about 1.3%.
That's right. It's about 1.7%, but the dividend has grown just around 20% a year over the last number of years and should continue to grow. So you're going to get total return, you're going to get share price appreciation, and you're going to get growing dividend yield.
I know some people class these as one of these so-called dividend aristocrats.
Right. Well, and it is because all of these companies have rock solid balance sheets, right? So when people get concerned about the ability to raise corporate debt, these companies, that doesn't apply to them. They don't need to raise capital. They've got a strong free cash flow, very attractive businesses.
Well, thanks so much. We're out of time, and you gave us a moderately encouraging thesis there. We're in a weak spot in a secular up market.
I would just encourage people not to get too bearish at this point where things are. It's probably the wrong place to be.
Well, thanks so much. Okay, David Burrows, we're out of time. On Market Call, the encore presentation, as we like to call it, runs Monday through Friday at 10 p.m. Eastern, 7 o'clock Pacific. Have a great day on the markets.